How's everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to get everybody an update on what's going on with bank bond portfolios. I have a series of articles here that I wanted to share with everybody from S&P Capital. So the first one here is from Monday, from June 17th. This is called U.S. Banks Pull Back on Bond Portfolio Loss Trades in Q1 as Treasury Rates Rebound. So unrealized losses on U.S. banks available for sale securities fell to the lowest level in nearly 2 years as less institutions executed loss trades. So in other words, less banks were selling these portfolios off at a loss to try to reposition their bond portfolios. And remember, we have two separate categories here. We have AFS available for sale, and we have HTM, which is held to maturity. So, and then continuing on here, so U.S. banks recognized $1.03 billion in realized losses on AFS securities in the first quarter, a sharp decline from the $4.17 billion in the linked quarter. And the lowest level since the second quarter of 2022, according again to S&P Global Market Intelligence. Meanwhile, the industry's realized losses on held to maturity HTM securities also fell to 317,000 from 10.8 million in the previous quarter, the lowest level since the third quarter of 2022. So after banks took advantage of a bond rally in the fourth quarter of 2023 to reposition their bond portfolios, fewer banks executed loss trades during the first quarter as rebounding intermediate and long-term treasury rates made loss trades more painful for banks in the short term. And I think that's the key thing, more painful. And we're going to, when I get to the third article, you're going to see some of the other strategies as to what banks are doing right now currently. So now here we got a couple of really good charts. This is for HTML, so held to maturity. And, we can see here, obviously, first quarter 2023, huge, steep losses here. Another big loss here in the fourth quarter. But, losses, going down to a very minimal loss there in the first quarter. Available for sale securities, however, losses still going, still a lot, the losses are decreasing, but still there and still painful. And now we've gotten to a point where banks are not repositioning. Remember I said back last year when we looked at this in the fourth quarter last year, when going back to December and videos that I did in January, I said that a lot of the smart banks were the ones that were going to reposition themselves then, the ones that were going to bite the bullet and take the loss and reposition their bond portfolios. Now, we're getting into a situation at the moment where they can't make the sale because it would hurt too much and the losses would be too big. So we're kind of getting stuck at the same time. Some of these losses are decreasing, which is a good thing. This is encouraging. The held to maturity loss minimize, getting less. That's encouraging. Largest recognized losses. So while the industry at large pulled back from selling underwater securities, reporting 3.15 billion decline in realized losses on a quarterly basis, and a 1.2 billion decline on an annualized basis, some banks still executed loss trades to boost future profitability. Among the 20 banks with the most realized losses on AFS and HTM securities during the first quarter was JP Morgan Chase, recorded the largest realized loss at 366 million. However, that total was a 377 million reduction from the previous quarter and a 500 million reduction from the year ago quarter. So 4 other banks in the group also reported reductions in their realized losses on HTM and AFS securities. EB Acquisitions Company recorded the second largest loss at 207 million. Along with JP Morgan, the losses at the two banks accounted for more than half of the industry's 1.03 billion in aggregate realized security losses during the quarter. And then we have here U.S. banks with the highest realized securities losses. JP Morgan here at the very top. EB Acquisition, Northern Trust Company, Regionals, Berkshire Hills Bank Corp, BOK Financial, Capital One Financial Corp. You can see some of the biggest year-over-year change. And then this is AFS, and we have one column for HTM securities, one column for AFS. You can see Charles Schwab, man, Charles Schwab taking it on the chin here. Boom, some big numbers there for Charles Schwab, and as you can see, that's why Charles Schwab is taking heat. Well, this is why everybody's we're looking at you, Schwab. And then it just goes on. Yeah, it kind of talks about some of these banks or whatever. What do you notice here? A lot of number of regional banks on this list. Okay, so now let's go to, this is from yesterday. So this is U.S. banks' unrealized bond losses climbed in the first quarter of 2024. So a rise in interest rates took a bite out of the value of U.S. banks' bond holdings in the first quarter, reversing some of the industry's gains from the bond rally in the fourth quarter of 2023. So yields, which move inversely with bond prices, rebounded in the first quarter as average treasury rates across 2-year to 7-year maturities, which encompass much of the bank's bond holdings, increased 36 basis points from the end of 2023 through March 31st. Accumulated other comprehensive income, AOCI, which captures changes in the market value of available for sale securities, worsened $9.1 billion sequentially to negative $262 billion in the first quarter, according to data from S&P Global Market Intelligence. So, yeah, these losses are still not good. So we saw, again, we kind of saw in the first article like a little bit of improvement. Now this is showing that maybe not so fast. There's a lot of red. There's a lot of red in that chart. You can go from third quarter last year, 337 billion, fourth quarter, 253 billion, and now back up to 262 billion. So 17 of the 20 largest U.S. banks by total assets recorded a decline in AOCI in the first quarter. JP Morgan Chase & Company posted the largest decrease as its AOCI fell 1.2 billion sequentially to negative 11.64 billion. Meanwhile, TD Group U.S. Holdings recorded the largest improvement in AOCI, increasing 815 million on a quarter-over-quarter basis. Adjusted tangible common equity, TCE, which captures unrealized gains and losses on held-to-maturity securities in addition to credit reserves, less non-performing and delinquent assets, declined in 12 of the 20 largest U.S. banks, including Bank of America, Wells Fargo, and U.S. Bancorp. Bank of America recorded the largest sequential decline in adjusted TCE at 8.29 billion, while Wells Fargo and U.S. Bancorp experiences decreases of 8.06 billion and 1.81 billion, respectively. And let's see here. And then we have AOCI and adjusted TCE at largest U.S. banks. Kind of a nice little chart there, and it just goes through kind of the top 20 U.S. banks and where they're at. AOCI on a quarter over quarter, negative for most of these banks. Adjusted TCE, kind of a little bit more of a mixed bag. So rate outlook, the vast majority of U.S. banks showed sequential deterioration in AOCI, with 3,227 banks posting declines in the first quarter and only 883 banks showed improvement. Meanwhile, 1,972 banks showed deterioration in adjusted TCE on a quarter-over-quarter basis compared to 2,454 banks that showed improvement. These metrics are expected to remain under pressure, with elevated interest rates likely to persist. In the Federal Reserve's quarterly economic projections released after the June 12th meeting, the majority of Fed officials now expect just one rate cut in 2024, down from 3. And then let's see here. It's kind of adjusted trends and overview. Okay, so again, this is looking at the AOCI, and then we're looking at the TCE, and we're seeing that again, this is still a big issue. So now let's look at what is one of the strategies that banks are now beginning to deploy in trying to combat this. And this is from Wednesday. So it says banks bolster capital, offset security sales with sale leaseback deals. So some U.S. banks are moving to sell their branch real estate properties and lease them back in an effort to raise capital and offset underwater security sales. Banks have announced at least 8 sale leaseback transactions in the last 12 months, including 6 just this year. The transactions in which banks sell branches and then lease them back from the buyer have become attractive because they free up cash that banks can use to reposition their securities portfolios and improve earnings without disrupting operations at the branches sold. Sources said in an interview with S&P Global Market Intelligence. Scott Merkel, managing partner at SLB Capital Advisors, an advisory firm that specializes in sale leasebacks, said he has observed an uptick in the transactions involving community banks in particular. The potential gain on sale from sale leaseback deals became especially attractive for banks following the bank failures in 2023 because they can be a highly effective tool for offsetting unrealized losses in banks' bond portfolios. In one recent example, Fulton Financial Corp struck a $55.4 million sale leaseback deal in May with Blue Owl Capital in conjunction with an underwater security sale after realizing a $20.4 million pre-tax gain on the sale from the transaction. In another, Atlantic Union Bank shares generated a $27.9 million before tax gain on sale in a $45.8 million sale leaseback deal, also with Blue Owl last year, more than offsetting the $27.7 million pre-tax net loss from a $228 million security sale, according to a regulatory filing. The deal was also accretive to Atlantic Union's earnings because the loss provision in the company's securities portfolio was hurting its tangible common equity, TCE, which we just talked about. Following the deal, Atlantic Union's TCE as a percentage of tangible assets rose to 7.15% at the end of the fourth quarter of 2023, from 6.45% at the end of the third quarter. There was no other way that we saw that we could go out and generate accretive earnings at the level that you could with the sale leaseback without diluting our capital, Atlantic Union's head of corporate development and strategy, Toller Cross, said in an interview. And then it goes into immediate returns. Banks can offset underwater security sales with sale leasebacks because of a 2009 change in the Financial Accounting Standard Board's accounting treatment of leases, which allows institutions to recognize the gain on sale from a transaction immediately. Prior to the change, banks recognized the gain on sale over the course of a lease's duration. So the immediate gain on sale from Atlantic Union's sale leaseback deal made its securities sale possible. I would not have sold my investment portfolio at a loss had it not been for the gain on the sale of the sale leaseback. I don't know how the math for that would make sense to us. Exactly the point. And then it says more on the way. Firms that have been buyers in recent sale leasebacks said they have more transactions in their pipelines. Blue Owl has a robust pipeline of potential sale leaseback deals and is currently in talks with around 20 financial institutions regarding assets totaling roughly $2 billion. The company has more sale leaseback deals set to close by the end of June and recently secured another $2 billion for additional deals, Roberts said. Roberts added that he expects the momentum of sale leaseback transactions to grow in the higher for longer rate environment. We have a strong perspective that this is only going to increase over time. Again, good strategy if you can pull it off, and if you have to do that. There's another side to this too. You start selling your branches, and what are you doing? You're selling assets, and you're potentially hurting the long-term franchise value of the bank, because now you go to sell your bank, and you don't own those assets anymore. You don't own that real estate. That's not a chip to be played to help you out long term. And you're carrying now you're leasing that facility. And, you're still paying all the expenses of that. I mean, most of those nets in the commercial world are triple net leases, meaning, you're still paying for all the taxes, the insurance, the maintenance, all the utility bills, everything else that goes along there. So that, again, I think if you're in the position where, you have to sell this bond portfolio, you got to sell these securities at a loss, and you got to find some way to offset that loss, and you could do a sale leaseback. That seems like a very viable strategy that might work for you. But all I'm saying is it does not. It comes with other issues. It comes with other consequences when you do that. There's pluses and minuses to everything. Everything has its pros and cons. The trade-off there in covering this loss, you're kind of giving up, I think some long-term value for the bank, especially if the bank would ever consider selling itself at some point down the road. But just very interesting looking at all this. I mean, obviously, this, the unrealized losses in the bank bond portfolios, the losses that banks continue to sustain on their available for sale securities, the fact that the held to maturity is still somewhat underwater, the fact that it's affecting the TCE ratios for a lot of banks at this point. This is a problem. This is a problem that is going to persist. And again, the longer that the rates stay higher, this is going to continue to be a problem. And again, even with the interest rate cuts that the Fed is talking about, 25, 50, 75 basis points, I don't believe that's enough of a reduction to basically bail out the banks that are sitting with these negative loan portfolios. So at a certain point, I think a lot of banks are going to be forced to bite the bullet and execute strategies like this to basically sell the securities, get rid of them, reposition your bond portfolio, and do some different things. It's either going to be raise capital, sell off some assets, sell off some loans, do whatever you got to do to try to make up that difference. So again, that's the kind of update. That's kind of where things stand. I will continue to follow this. Obviously, it's one of the major stories in the banking industry right now. I will continue to follow this throughout the rest of the year. We'll continue to see what happens. If there are major updates, I will let you know. I would also tell you to go. I just did an episode on the fifth largest bank in Japan this week. Basically decided to dump $63 billion in U.S. bonds because of their underwater security, their majorly underwater securities portfolio. So if you got interest in this, go check that out as well. So, but anyway, I'll wrap up with this. So if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to leave your comments down below. You can find us on YouTube, Rumble, and all major podcast platforms. And I will be back to see everybody again real soon. Thanks a lot.